Okay, we're going to kick off with my first guest because UBS has made some significant changes to its resource calls yesterday. James Gerrish from Shaw and Partners, an author at Market Matters, joins us to get us across these moves. I did see yesterday, in fact, I was talking to Martin Crabb, of course, about some of the changes in the, ratings amongst brokers for some of the resource companies. What's happening there? Just getting a little bit pricey up at these lofty levels?
Yeah, morning to you, Kyle. I think that's 100% the reason for the change in rhetoric coming out of UBS around resources. So basically, it is saying that the likes of BHP, Rio have run pretty hard, pretty fast since October lows. So they've put on sort of 35, 40% in terms of share price. The same could be said in the copper space. So Sandfire. So they've moved to sell on both of those. They've moved to a hold from a buy on Sandfire. I mean, Sandfire has ripped in terms of share price after BHP's focuses attention on Oz Minerals. Sandfire is going to be sort of the main copper producer listed on the ASX, so it's naturally been in the focus for investors. So just taking a bit of cream off the top in some of those calls was the expectations from UBS.
Yeah, okay, so trim, perhaps, as they say, if you've got exposure there. Obviously, it was an extraordinary run up if you managed to get close to picking the lows there for the likes of Fortescue. I think it was over 40% higher since the October lows. But let's chat bond markets, shall we? That CPI data last night, we saw a little bit of a tech rally, I suppose a duration play coming through there as expectations for hikes are tempered. How do you interpret what came out of that CPI number, what it means for bond markets and obviously by extension equities?
Yeah, I mean, the clear takeaway to me is that, inflation's peaked, bond yields have peaked, and equities have seen their lows. So obviously, that's not a big call now that equities are sort of 13, 14% from their lows. But that's sort of the broad picture you need to, construct your portfolio views around. So, there was a really volatile, huge session really in bond markets overnight. So there would have been a large suite of bond traders that had a tough night overnight. I mean, the US 2 years fell 24 basis points as soon as that announcement was made. They settled down about 16 basis points, 4.2%, but a huge night in terms of what played out in bonds. They're still expecting a 50 basis point increase when the Fed meet tonight, but ultimately rates are going to. You touched on it earlier. Rates potentially there's going to be a pivot from the Fed in earlier calendar 23, and that's going to be guided to potentially this week. So, rates not being as high as expected. The most aggressive tightening of monetary policy in history is working, and the Fed won't have to do as much. So that's ultimately a positive for equities, all things being equal.
Yeah, we're halfway there to a Santa rally if I suppose the FOMC comes out relatively dovish. Again, it's all relative there. But let's get a take on the banks because we had Bendigo releasing results yesterday. A fairly positive set of numbers, really padded out by sort of stronger margins. What are your takes on the banks more broadly? Because there's a bigger debate, I suppose you could say, as to how they might perform next year, especially given the fact that, if you look at CBA, not far from record highs up until recently.
Oh, I mean, CBA has been a phenomenal performer, but I mean, yesterday's Bendigo Bank result was, was a trading update. Things are going well over at Bendigo. I think the biggest surprise to me, and you touched on it, is around their margins. Obviously, they're benefiting from a higher cash rate, so they're more leveraged to the higher cash rate than perhaps the market expected. That drove their cash earnings at 245 million for the 5 months to November 30. That was about 15% above consensus expectations. So a really strong result. I look at margins. So the margins for the period were 1.85% at the NIM line. But if you look at the exit margin, it's sitting above 2%. So you sit here and go, everything looks good for the banks at this current point in time. You look at Bendigo, it's going to have earnings growth somewhere around that 15% mark. It's trading on sort of 11 times. It's yielding nearly 7%. So all those things look good. It's how you think about the 2023 or calendar 23 and 24 that's going to dictate your view around the bank. So will they eventually, if we've got leverage to higher rates, that leverage also plays out to lower rates. So if the economy goes through a bit more of a difficult patch in 23 and rates, potentially need to be cut, then banks are going to be on the other side of that, coin. So I guess how I'm playing it at the moment, we're slightly underweight the sector, but we are looking to increase weightings given the sector has pulled back. You made mention of CBA. We've got CBA in portfolios, but we're looking at, considering recycling some capital out of CBA into some of these cheaper names that have pulled back. Well, CBA, it's obviously the most, it's the premier bank in the sector, but gee, it's expensive.
Certainly is. Round things off, G8 Education also had an update yesterday. What came out of that?
Yeah, an interesting one for G8, which is obviously childcare operators. They're in a turnaround phase. They've had a pretty tough last 2 years, really, across a number of fronts. They showed some, improvements in terms of occupancy. They've shown improvements in terms of inquiry levels. One of the things and that's driving, an improvement in second half earnings in particular. So they're going to meet their full year numbers. They're a December year end, so we're end of November. We're pretty much done on the year. EBIT at 71 million before December. Last year they did about 4 million in December, so they should get to the 75 million at the EBIT line for the year. So they're going to meet consensus expectations. One of the things that's sort of hampering their recovery is labour shortages. So they're not operating at capacity in some centres because they can't get staff. Simple as that. So if they sort that out, or the government does some things to sort that out, that's going to be a positive for them. But the turnaround remains on track. It's cheap. It's got a few warts on it, but the turnaround remains on track. We own that stock in our income portfolio and are going to continue to hold it.
James, great chat. Really appreciate it. We'll talk soon. James Gerrish from Shaw and Partners.